Ladies and gentlemen, welcome to the Sofi Weekly with a very special guest, Tim Sweeney.
Hi,
Tim, we saw essentially an article on Twitter. Okay, it wasn't a tweet; it was an entire article. I'm sure this was like 3,000 words. That you broke down why you are pissed off about the misinformation, about the lack of understanding of SoFi's lending practices, some of your thoughts on the tech platform and other products that SoFi offers. And we knew we had to have you on the channel. Thank you to Tevis for reaching out and you accepting to come on, because we're all very excited to have you here. So Tim,
glad to be here.
All right.
So what was the question?
Are we going to start with this tweet? This is a candidate for the longest tweet ever tweeted.
All right. So I'll tell you,
I'm just going to go through the tweet and just ask the question. So you started out with your background. Do you want to tell people your?
Yeah,
what you do for a living.
Yeah. Well, I mean, I was always pretty good with numbers, but I'm now pretty good with writing, 25,000 character text in the middle of the night. But I was an accounting major at University of Illinois, and I took the CPA exam. I was about 15th out of 65,000 people. Then I taught accounting at Michigan while I went to law school. Then I was a partner in a major law firm, partner in Deloitte. Was a managing director at a wealth management firm, and then restructured a major Fortune 500 company and consulted on lots of restructuring. So a lot of tax work, a lot of corporate work, banking work earlier in my career.
Here, I'll show the tweet off for people, just so you guys can go and follow him on X at Tim_Sweeney_TAR. So you can see this tweet here. He goes over his background, the transition that they're going through, the roadblocks. We're going to get through all of this, but if you just see the sidebar on the side of the screen, we are just getting started here. But yeah, so let's jump into it.
Okay.
You had gotten pretty frustrated on the idea that people did not quite understand SoFi's lending practices, or quite understanding why they're going through a transitional period right now. What are your thoughts about why SoFi is needing to decline in lending revenue currently for this year versus what we did in 2023? What's different?
Well, I think there's two aspects there's a business perspective and the accounting perspective. The business perspective is, you go from student lending, relying only on student lending, then you're relying on only personal loans, and they ramped up, like I think I said in my article, from in 2-year time period, they ramped up from, by a factor of 5 or 6 up to, 15 billion in personal loans. And at some point in time, you can't just be a personal loan company. You got to be a bank. And so you got to transition into being a bank. And so that's the business perspective. You got to then the accounting perspective is they had $710 million in fair values. And at some point in time, those fair values, they can go on and off. So some fall off and some are added on when you keep new loans. And so if you keep going loans forever, you just keep adding up those fair values. And at the rate that they were pushing personal loans, those could be like 1.5 billion. So that's like $1.50 in fair values you have, that if you have a certain event, that's going to cause potentially $1 or $1.10 loss in any given quarter. And then the price of your stock and the institutions, everything, they probably have a very negative reaction. It might be a kill your company moment. So you have to figure out how to do something about that, right? So when I looked at this the first quarter, they said they're reducing lending. I go, oh, I know exactly what they're doing, right? So what they're doing is they're restricting lending so they can have better loans than they otherwise do. So they go up the FICO score, up the cash flow score, up their model. And so those loans should have lesser default rates, and they should have higher premiums. And so when you sell those at the higher premiums, you can get more income from those fair values, and you can use that income to offset the runoff of the other loans. And by not putting new fair value loans in held for sale and and holding them for sale, not selling them, you're not building up fair value. So you can run off those fair values over a matter of time. And that gives you time this quarter or this year to be able to run most of those off. And at that point, you can say, at some point, as a bank, they have to hold loans themselves, not sell all their loans, right? And they've shown that by keeping the loans, they can get a pretty substantial NIM. And in the future, what they could do is say, all right, we're going to take our best loans and we're going to hold those. Those will have low default rates. Then, like the second best loans, but still really good loans, we'll sell for premiums. And even if they have a loss sharing agreement with that, you won't have the defaults because you've sold the loans, right? And then if you want to balance that, you can balance it off with credit default swaps or other credit lending notes, and you can avoid some of those defaults. And because the defaults are really the key in any bank, right? I mean, you have loans, you get return, or they default. It's kind of a simple. When you simply look at it like that, you just that's the issue.
So one of the questions, at least that I had, whenever you were talking about SoFi transitioning to even higher credit underwriting, like getting better and better clients, would that not potentially slow down or impact their coupon rates of their average loans, because potentially they would give out better rates to people who essentially deserve them?
Well, I said that on one tweet at one point in time. The farther you go up the credit, say FICO scores, but it's more than FICO scores. The farther you go up that, the less likely you're going to get personal loans. Like, I have 850 credit. I'm not getting a personal loan.
Yeah.
Citibank has a product. I have a credit card with Citibank that I can get a 1-year personal loan at 5%. You pay it up front, you pay 5% later. It's 5% loan, right?
Mm-hmm.
So they're going to have to compete with products like that. There's ways they can do it, right? But it's you're going to lose a little bit of that. But there is more volume there that you can get by slightly you restrict it first, then you go down a little bit. You ease some of that restriction to get to the number you want, to what you can sell. So at some point, you'll be able to sell them at a lesser premium, but you'll still have more premium. So if you sell more loans, it's a balancing factor between how many loans you're going to sell at what premiums, right? You want to sell one loan at 7%, or you can sell 20 loans at 6% or 50 loans. So you can walk it down and figure out what you do. They do a really good job of managing their numbers. They really do. And people will say, oh my gosh, well, they're managing their numbers. Well, everybody manages their numbers. If you have consulted with a public company, they all sit around at the end of the quarter and manage their numbers.
Yeah, another big factor, at least in the last quarter, in regards to sort of managing their numbers, was that sale of, highly delinquent loans or
Right.
near delinquent loans. What did you think about that? I think you had some comments about it in your article, but if you could express those, that'd be great.
Well, it's totally reasonable to do, because as they're ramping up all these personal loans, even if you have an automated process, you're going to have a lot of people involved, right? And so they probably, at this age in the bank, don't have a really great workout department to be able to identify the loans and work them out. It's a thing that every bank does. Every bank has a workout department. As soon as somebody misses a payment, they'll call you. Now, they don't do it with credit cards because they don't really care that much about credit cards, because they're charging 28% interest. But for personal loans and stuff, they can work that out. They can sell them before they come default. It's fine to do that, and it's not in defaults. There's a lot of things you can do to avoid defaults. You can say, okay, well, how you doing? You're going to skip a couple months. Why don't we modify the loan? We'll lower the interest rate a little bit. We'll stretch it out. You'll do whatever you can to avoid default, because a default, not only you lose all the principal of default, because once somebody defaults and you have them default, they're never going to answer the phone again. They're not going to pay it. So you got to work with them, and you work with them to maximize your return on that. And because once it defaults, you take away not only your principal loss, but you lose those fair values immediately. So get written off too.
Mm-hmm. So Tim, I'm curious, in the lending segment, because that's the segment that is giving a lot of people pause right now. The plateau, let's say, in the lending segment throughout the year. How do you think about that as we go potentially to have a rate cut towards the end of the year, in terms of, do you think that's going to be down or closer to flat, or maybe even up single digits? And that breakdown in terms of personal loans and student loans and home loans, that mix in terms of the originations and in terms of the actual revenue for lending, like, how are you thinking about that relative to what they've guided for?
Well, as you guys have said on your show a lot, their guides are really conservative. The guide for the first quarter was similar to the guide for the second quarter. And what they came in the first quarter is similar to what the market had proposed or suggested they would have for the second quarter. So I'm not worried about them not coming in the numbers, because they could just go up and down a little bit on their credit quality and ramp up those loans. I think their opportunity was a tremendous advantage when Powell said he's not going to raise rates, because I don't think the Fed can raise rates. I think a lot of the inflation is built in and coming down. I think food inflation is still a little bit high, but I don't think the Fed can afford to raise rates. I think the Fed at 3% can't just have just lose their momentum in this and just start raising rates again, because that's going to be a disaster for everybody. And, for commercial loans, office loans, especially in some regional banks. But towards the end of the year, they had this opportunity now. So they can run off these loans and still do higher coupon loans right now. So instead of 14.5, if they go up the stream and they get 14 or 13, that 1% is not going to be that material. Maybe they don't run off as much loans. Instead of maybe 100 million second, do they 90 million? But the lower they get that, it takes the probability of a disaster off the table, right? And I think they're turning that from 718 down to 600 and some million in the first quarter. Shows you something. The other thing it shows you is if they can run off those and have write-offs of 100 million, which is about 10 cents a share, and still report 2 cents in earnings, that's 12 cents a share, right? So if they do that the whole year and they report 10 cents a share, that's really effectively 50 cents a share on an ongoing basis. So how well they do that and manage that is you don't know. But I think that is their goal, or that should be their goal. And so if you look at Noto's background in some of the speech he gives when he played football, he says, you always play defense. You always play defense. You can beat a better team by better defense because you keep their offense in the field too long, and then you can do it. And then you know when to ramp up offense. If you take him for his word on that, and that's, everybody is defined by their history. That's what he's doing. He's playing a little defense here. He's going to not run personal loans up to 18 billion. If they do what I think they would do, is run off these fair value loans. What do you have at the end of the year if he runs them down to 100 million? Where's the bear thesis then, right? The defaults, because if they're ran off, you still have defaults, and in a declining interest rate environment, which I told somebody on Twitter earlier, or X, it's a complete advantage. So what Noto did is set up the advantage for them, because they can have some stability while they're running these off. And then when loans start refinancing, if they don't refinance if they refinance to Sofi, they could modify the loan, or they could take some of the loans in 1 month, slow it down, the refinancings, because some people naturally will wait for the second fall in rates to refinance. So if they go slow enough, that's an advantage to them. If they go really, really fast and they had 6 rate cuts, right, like March, June, August, such and such, you could have so many people refinancing, and they're not charging a fee for the refinance. And every time somebody refinances, their prior loan and all that fair value gets written off. So that's not a profitable incentive to do. So what do? You slow it down, right? So you're not adding on additional fair value, but you're subtracting fair value. And to do that, you have to have more income. To have more income, you have to go less defaults. So if you have less, especially if defaults are being an issue, you have less defaults. It's going to help your fair values in your inventory. It's going to actually help you on the new loans to sell them, and you're going to create more income to offset what are those fair value runoffs.
So I've got a two-parter here. First, I think that the bears would shift the thesis to say that if you want to slow it down, start writing off a bunch of those fair value adjustments, then it's opportunity cost, because the stock can have low growth throughout the year. Is that fair to say?
Well, I remember I had on our private chat with Chris Hager, I was talking about where we thought the stock would be after the earnings. And I said, after the earnings, I think it's going to go as high as 820. And then I said, it's going to go down between 7 and 9. I said, it might stay there for a longer period of time because of what they're doing. So, I'm not that concerned about stock price. I mean, to some extent, I'm in the camp that, if it's $7 to $9, it's $8 in July, I'll buy more than $8. I'll buy more at $9. I'll really ramp up my purchases if something happens and it goes to $14. because then you're going to have a lot more institutional buying at that point in time. So I think the people that track this, I mean, it was like, as irritating as some of the bears' thesis was to me, it's also, you have people say it's a 5-year investment, and then when they don't hit their numbers and the stock falls $1, they're like, oh my God, I got to get out of this, right?
Yeah.
That's not, I mean, I'll give you a prime example. You guys follow New, right? And Warren Buffett bought it at $9. He didn't sell it all at 4 or 5 or 3. He didn't sell it, did he? Right? You got to look at the business and what's the business. The SoFi business model is a disruptive model because banks can't compete. And I'm not saying it's Amazon, but the theory is that's what everybody said about Amazon. It's just a bookseller. It's just another bookseller. They're just another bookseller. But my thesis is, even if they didn't have the tech, they could be very successful as a bank. The one thing they need to be very successful a bank is a better credit card, right? Because what do all banks have? They have savings, deposits, and credit cards. They're not hitting on all cylinders in credit cards. So I would concentrate on that. It'd be my next one. Why? You say, well, it's a loss. You want to get rid of the loss? No, because when you turn around a loss to profit, you get like a double gain, right? Mm-hmm. So they need to come up with a better credit card, and they need to come up with something that fits their company. The company is will help you manage your money, right? What's their tagline?
Your money right.
Yeah, get your money right. You can't get your money right paying 28% interest on a credit card, right? So they need to think outside the box on that, right? If you think outside the box on that, they have a huge opportunity that banks can't match by tying a credit card to a number of different things. They could even have a credit card. I'm not going to the details because I don't want anybody to take it or whatever, use it. But they could have a credit card that effectively gives low credit quality people 10% interest without defaults. It's quite possible. The question is, how much do they want to do it? But you got to get off the 28%, I think, in credit cards, especially for somebody who's in my credit quality, because they're never going to have a balance.
Yeah. Yeah. Oh, did we lose Tim for a second here? So this happened backstage. There was a couple
times I'm moving this around was 6%. I'll take the 5 or 6% and I'll take care of it.
I think we lost you just a little bit there. Were you talking about better rates on the revolving credit for credit cards, or revolving balances on credit cards? I think he's still. Anyway, Tevis.
Yeah.
Is he gone on your side as well?
He's gone on my side.
Okay. All right. Well, hopefully he comes back, because it was actually a really good string. I was getting really positive there. Oh,
there he is. So where would I leave off?
The 28% not being sufficient value for people. Yeah.
Right. You can develop a credit card that pays a lot, that people pay a lot less interest, because when you get to somebody at the upper levels, 160, 180, 200, they're just not going to carry balances on their credit card, so it won't be profitable. But if they carried some balances and they paid 10%, it would be profitable, more profitable. And I think that's the problem they're running into right now. The quality of their people that are using the credit card, they're just paying it off. They're not carrying balances, and then the lower level credit people are carrying balances and defaulting, and the interest doesn't catch up. That's what would be my best guess.
So I had another really important question about your article in regards to some of these fair value adjustments, where you were talking about the 2026 guidance of getting to potentially 55 to 80 cents.
Right.
And you said, currently we're putting up 2 cents EPS a quarter. Let's say we get to 8 cents, but these fair value adjustments are essentially writing off 110 million a quarter. You said in your article, if that was on a diluted EPS basis, that would be 10 cents. But wouldn't that be like 2.5 cents?
Well, if you're a billion shares and you're writing off 100 million, it's kind of 10 cents, right?
Yeah, but I think
what's the diluted share count?
I'll need to look. But then why, whenever SoFi put up 88 million, was it a 2 cent quarter?
was fully diluted. Yeah.
You
What do
know,
you
or
mean?
else that would be a 9-cent quarter.
Sorry, what do you
Well,
mean? The 88 million was the one time. It was 29 million that
that was with the $59 billion gain. So that was a special item.
All right. Well, look. Okay, I guess. Sure.
So
Sure.
I mean, it's a simple calculation. If you have 1 billion shares and you have $100 million of expense, that's a 10-cent hit.
Yeah.
Right. So if they can ramp up their profits and sale loans, which was selling 1.9 billion, which they did, and they can get to 2 cents on a fully diluted basis, it would be higher than on a non-fully diluted basis. That 10 cents should run down to that 2 cents and make it 12 cents. So then you're like a substantial greater income you would otherwise have going forward, because you're not going to run off an extra 300 or 400 million the next year, because there's not going to be that much.
Gotcha. So you think that they're going to continue to have these adjustments throughout the rest of the year, about 100 million or so of fair value adjustments that they're writing down. What did you say was quarter over quarter in terms of a percentage?
I didn't say what the percentage was. I said I would like to see them run off at least what they did in the first quarter every quarter, but that's going to really depend on how much, they're not going to say we're going to write off 100 million this quarter. They're going to say, how much income do we have? And we still want to be profitable, and let's run off whatever we can, depending on how much income we make. That's the idea. That's what I would do.
Got you. Yeah, those were my questions for now. So maybe Tevis or Roy.
Yeah, I've got one. So let's say that they start cutting rates, and it's a worst case scenario. It's the Fed typically, misses the mark. We don't have a soft landing. They're cutting rates because of a faltering economy. Things are falling to pieces. And of course, there's people that are interested in refinancing at that point. As far as them basically, maybe it's not quite the right term, but a mix shift that they're moving from the type of loans, from the personal loans to more of the refinancing side. Is there are those considered safer as far as default risk, or is there an advantage of that sort? Or why would it be more desirous as SoFi moves into from just a personal loan refinance company to they're more than a bank, but to a bank for this switch in loan type?
Well, the switch in loan type is probably not really called a switch, because you're just going to refinance a personal loan into another personal loan for the most part. But you have an advantage, because when rates fall, you do have an advantage that your existing loan book that has low default rates is worth a ton more. So to the extent, that's going to make up, if you can get in the argument, it's just kind of a balancing approach of like how fast rates go up, then those value the loans, people will start buying those loans hand over fist at higher values, because interest rates are going down, right? And so as the interest rates go down faster, you'll find that their existing loan book goes up value further. Now you might offset that because you might have additional defaults. So like I said, it's a balancing test. You don't know what it's going to be. You manage your defaults, you sell some of your loan book to increase your thing, and you refinance those loans, and in the manner that you don't create additional fair values, and you're pretty well set. But you're going to probably be, you're probably going to take that 92 to 95%. I think it's going to be more like 100%. I think it'll be like they'll hit 100%. Especially in that environment, that might hit even more. At that point in time, you just ramp it up, because you're going to get a lot of customers and new members from other people. You're going to have a little special refinancing. You're going to have another, your customer acquisition costs will go down, because people are just coming to you without you having to spend a lot more money. You'll spend some marketing spend, but in that kind of circumstance, and then who knows, if you get into a recession, you go farther. You take something good, it's good for a while, and then you take it farther, then it can be bad, right? Because then your defaults can rise later. But defaults are what people usually manage at banks. The best thing, the job of a bank is to manage their loans, right? Manage your defaults, then originate new loans. So you got one half is originating loans, the other half is managing those loans, and that's where banks don't get in trouble. I mean, banks get in trouble, like Silicon Valley Bank. They don't do a good job of managing the investments they have, because they're just randomly and actively sending out loans to everybody they know.
I want to ask, I mean, In our DMs when we were chatting about this, you were saying that you were seeing some angst by retail investors, and I saw it too after the Q1 earnings report. Based on the stock price falling, people are very short-term oriented, and their emotions fluctuate based on if the stock is red or green on any given day. But you also said there's a bunch of misinformation out there, and that's also what led in part to your post. Is that predominantly in the lending segment and also with regards to their loan book? Or, I mean, if we open the field in terms of the line of questioning, what is the main thing that you think people get wrong or are misinformed about SoFi that you sort of want to call out?
Well, the first thing that got me to write the post was all the different bear theses, right? Like the discount rate. So the discount rate was in November where people said, "Oh, it's the discount rate. You can't have a discount rate close to the Fed rate." And it gets a little complicated, but generally the way you do it, the discount rate is you use a higher discount rate if you're using the 14% loans and you're not subtracting for cost of capital and you're not subtracting for defaults, because that benchmark index will include that, right? Based on the averages. Now, you don't want to use the averages because you're above average, right? So it's like if I get a credit card that says the average guy does this, I go, no, I'm above average. So then what they do is they take the returns and they subtract the cost of capital, they subtract the defaults, and you're getting a risk-adjusted return then. So that risk-adjusted return is basically close to a Fed rate. You just have execution risk on that, right? And event risk, like a significant event risk that somebody doesn't pay, but it's closer to the Fed discount rate. So that was one that then got debunked. And then the next thing that came up was the capital ratios. So in November, people said they're going to run out of capital. There's no way to give them capital. They have to do this. And I said, they could just they could just buy back all the convertible loans at a 30% discount and create up 2.4 billion of space. And they can do other capital maneuvers. It's not that bad. And then it goes to the fair value accounting and how and this is a good example for you guys, because if you take the same loan, say you have a $100 million loan, and it's 5% defaults and there's a 4% premium. Under fair value, one's 104 and one's 95. But over the term of that loan, it's exactly the same to the bank. And I'll ask another question. What do you think it is each year in cash flow? It's exactly the same. It's exactly the same cash flow. That's why when people private equity guys buy companies, they do cash flow analysis. They don't use financial statements. They take stuff from financial statements, but they always do their own discounted cash flows based on what their own assumptions are, garnering information out of the financials. And so that's kind of what got me to write it. So they keep coming up with these bare theses. They're just flat out wrong, or, I don't know if they don't have enough information and they don't know the rules as much, but there's a lot of stuff that goes on Twitter, like, the other way it's like, okay, well, SoFi's going to 10x by Monday. You see stuff like that. And so I just wanted to do a post that kind of debunked all the bad things and got back right to the point where people could understand what their risk is, right? The risk is always a default risk. The risk is always a growth risk. Are they growing? Yes, they're doing a good job growing. Are they managing defaults? Yes, they are. Do people not believe the defaults? Well, everybody has their own network, I guess, but I think the network you should use is a neural network and try to figure this out and understand it. So I was just trying to provide a post, and as I got through doing this on my phone, I just got, let me talk about that. Let me talk about that. Let me talk about that. Because it's just things that from my experience, I thought would be a good idea to focus on. But it's not the end all be all of anything, but it's just to give somebody some background.
Yeah, look, I think the accounting methodology is a very easy thing that people rely on for a bear case, because it's always hidden behind this veil of complexity that the average retail investor can't really penetrate or understand. And the fair value accounting has been criticized in large part, and also the fact that they don't report certain numbers the same way that other banks report certain numbers. And so automatically the assumption goes that there's something, that's not right there, or it's always a negative sort of connotation.
Right. It's kind of a misunderstanding of the fair value accounting. It's kind of a legitimate criticism of the fair value accounting. And it's also kind of some laziness in analysts because they don't understand it. Like I explained earlier, it doesn't really matter over the term of the loan. It does. Oh, so the bare thesis is, well, you're recognizing income as faster than you can, right? But then after the next year of the loan, you're recognizing the losses faster than you can, right? So and their thesis is you got to keep ramping up those loans to cover the losses that are running off it because you're putting them in the beginning. And that's kind of a fair comment, except for the fact that SoFi did their best in that situation to grow their loans in a very difficult environment, right? And so in the difficult environment that they were in, they did the loans and they make all the right moves. They did all the right capital restructuring, in my opinion. People talk about dilution. I think one of the concerns people go, oh, we're going to be diluted, we're going to be diluted. But I'll ask you this question. When you do a stock split, you get your number of shares diluted, right? And that's generally a good thing. When you do a reverse stock split, you get accretion in your shares, and that's generally considered a bad thing. Dilution in number of shares doesn't mean anything, right? For example, you get dilution with the 2026 or 2029 notes, you might get some potential dilution, and they cover it with a capped call. But where you don't get dilution is the stock stays in the same place. Now, as a shareholder, based on price, do you really care about 10% dilution if your stock goes from 10 to 40? No, because then they use the money from that dilution or whatever they did got from that dilution to effectively grow their EPS for everybody. But where you're worried about dilution is what if it stays for 7? Well, then you're going to get no dilution. Yeah. So you're actually protected in dilution in the downside. And on the upside, you're going to get some dilution, but dilution only matters depending on how the company manages the resources they get to cause that dilution.
Yeah.
So you kind of
it's sorry, just last point on that dilution point. I think it's emphasized as a criticism because of what the stock price has done, where people say, okay, well, if I bought SoFi at 7 and they had, a certain share count, and then they're still at 7 3 years later, and that share count is maybe 10% more, then all of a sudden, they care more about it because the stock hasn't done a 2 or a 3 or a 4x. Because if we were sitting at $20 right now, literally nobody would care about the dilution. Right.
Well, that's a legitimate thing. I mean, it depends on how much of your money you're investing and how much is it in there. I mean, if it was like 1/10 of 1% of your portfolio, you wouldn't care about dilution. But there are a lot of people that I think jumped on the I'm going to get rich bandwagon, and it's going to go up rapidly. And why aren't they doing business banking and a new credit card and all this at the same time? Well, I mean, you guys know, I mean, a lot of guys in our private chat, they, especially Vadim, who's like, you say, I was looking and where this is, and suddenly he flashes it right to you. You get that information. It's not that you can't do all this stuff at once. And while I would love the stock to be 25, my real concern if the stock goes to 25 is not now what will I do with it, because then you get a 300 or 400% bump, and logical says you got to cut some of it. If it goes slowly up to 24, I probably won't cut any of it. I'll probably buy more of it. So in the long-term opportunity, you got to figure out if it's a long-term opportunity for you or not. And a lot of retail shareholders, that money was hard fought for them to save, right? Hard fought money. And they're not gaining anything, and they say, I could be in this, or I could be in that, or I could be in NVIDIA, I could be this. And it's like some of the bears say, oh, you have this opportunity cost, you're missing the opportunity cost. But if you bought the stock for 10 and you sell it at 7, you take a 30% loss. To get it back up to 10, you're going to have a 46% gain. So what stock are you going to invest in that's going to give you a 46% gain in 1 or 2 years? Then you ask yourself, do you really think that SoFi in 3 years is not going to be $11 stock? I mean, how many people think that?
Yeah.
So from a wealth management perspective, when I was managing director of this wealth management company, and we were talking to people with billions of dollars, they're like, we want to, a lot of them are gamblers. And what we just came up with, what a lot of wealth management people use now is, you take a third of your money and set it aside and treasure something really safe to provide for all your living expenses the rest of your life. Then the second tranche, you get like stocks, investment, index funds, something that's safe that's going to grow. Throw in a couple of risky things here and there, and that third takes care of your kids' lives. Then the next third, you do private equity or something to get really outsized returns. And if people thought about it that way, it's kind of hard to do it when you've got like $10,000. Say I'm going to do 3,000, 3,000, 3,000. But if you only have 10,000, you probably shouldn't put your own 10,000 into SoFi, right? Because you're gambling at that point, because you need the money. And if you need the money, you're going to have to get out at the most inopportune times. And most people get out when they lost money because they're afraid of further losses.
Unless you take that 10,000, put it into SoFi's checking and savings and make a straight guaranteed 4.6%.
Well, I can't tell you how many people that I know that have or are getting in this year significant amounts of money who are doing just that. They're putting it in their 4.6%. I know somebody that's got inheritance, and they said, "What should I do with this money I want to return?" I go, "Would you need the money to live?" She goes, "Yeah, I need the money to live." And I'm like, "All right, well, just throw it in SoFi at 4.6%. You're going to get $2,000 or $3,000 more a month, and you can live on that."
Yeah, no lockups.
Yeah.
I actually have a question from the audience here. B-Dub says, can we get Tim's thoughts on interest rates dropping while SoFi holds APYs at 4.6%? So do you think that will be their strategy, that they continue to hold up high cost of deposits?
They'll hold them. My personal viewpoint is they'll hold them up longer than other people. But as the spreads retract, they can afford to keep it up with their inventory of loans that will be increasing in value, right? So the inventory of the loans they have will be increasing in value. So that means the value of the loans goes up. But as the spreads for new loans go down from 14% to 12 to 30, say it goes down to 6, you can't keep it at 4.6%. But they can keep it. They can keep it higher for longer.
You're talking about the new loans that you're writing at
Right,
lower coupons to stay competitive.
Right. To stay competitive, your cost of capital is higher, your spread's lower, and since your spread's lower, your defaults may stay the same, or they may actually get better. But they'll keep it up for a while because as rates fall, they'll have an advantage. I think the interest rate environment is setting up pretty well for them. I mean, contrary to what people think that for other banks, but for them, it's setting up pretty well. Sometimes if you're running a marathon, you might want to stop and rest so you can finish the marathon. Sometimes if you go all out on everything, like I've said on X to a number of people, I said, the biggest risk to SoFi from last year that I thought was they grow too fast. Because when you grow too fast, you don't have the infrastructure to support you. You get up to a number of different products that you're not ready for. You lose your customers and you lose your momentum. And taking a pause, and I don't really think they're taking a pause. I just think they're conservatively saying they're taking a pause because that's what they're going to do, and they don't know what the environment's going to be. And remember, he said all this. The key thing is he said all this before Powell said he wasn't going to raise rates. So that's something to keep in mind. When Powell comes and he says, "I'm not going to raise rates," the question is, do you believe Powell or you don't believe Powell? Will inflation change or such that it will have to raise rates? I think he's going to be very reluctant to raise rates. And so if that's the thesis, if you believe that, then they have a runway to get rid of all their problems. And the bears aren't going to like it because they got rid of their problems. And at some point in time, after the second quarter, if they have like 2 cents after the second quarter and they beat not only their guide, but the prior street guide, and they ran off the 80 million, 100 million of that, somebody's going to understand, if they didn't read my article, some of the shorts know this stuff. They know this stuff. Everything I put in that article, the shorts know, but they're just counting on the other people don't know, right? Mm-hmm. And so at some point in time that'll turn. You'll see the gradual reduction of the short interest. You won't see it rapidly because you're not going to these short interest from the delta hedging. They're not going to cover that, right? Because they want to keep that open. Right, they keep it open. They've got themselves covered by the conversion. It depends what the stock does, how the conversion. They still have the money that they're shorting. They're using other places to make an additional interest return. So the total short interest is a little bit off. It's not as high as you think it would be for actual shorts to get something like a short squeeze. So that's probably not that significant, but you'll see it bleed off. Like you go to from 180 million to 160, then 150, then 140. Then you want to look for that at the same time that institutional ownership rises, because that means that they're turning. But institutional buyers kind of like to have, at least in remember mutual funds, you couldn't buy a stock under $10. So you got to get the price of it sometimes. I think the price value of the company is probably significantly low what the actual value is. But I think part of that is the tech being like, we're right around the corner, and people get kind of saying, well, you're right around the corner. Where's that big bank that signed up? And it's just not that quick. I mean, I was involved with a company we were structuring. We were going to Oracle, and we looked at our existing systems. We go, if we blow this up in the middle of changing to Oracle, we're screwed. Our company's done. So you have to have a lot of consideration. And in the end, we chose not to, because we're like, we were selling the company. We were hired to restructure the company and sell it. And I said, we can't do it. And the new buyers said, yeah, it's not a good idea because we're borrowing all this money to do it. We'll do it a couple of years later. And that's kind of what they did. So it's a multi year process, right?
Sure. So
Sure.
let me ask you this just before we go deeper into that tech platform. With regards to that short interest and gradually coming down, and that institutional ownership gradually increasing, as SoFi continues to report, beating analyst expectations on the bottom line and continuously being profitable throughout the year, do you think that there is going to be an inflection point from the stock perspective where you're just going to see a quarter where it just jumps and then you sort of have capitulation on the short side? Or is it just going to be a stair step gradually upwards each quarter?
I think it'll be, I think the overhang will always be the fair value accounting. And when the shorts realize that the fair value accounting and inventory is going down and the defaults are staying steady, at that point they lost. They lost. And then, but then the question is, what's the macro environment? You can never say what it will be unless you tell me what the macro environment is, because it's going to be, if it's the same macro environment as now, the stock will drift up a little bit as rates start to fall. And they say, it's all, from my perspective, it's all about member acquisition, right? So say they developed a credit card that was a 10 or 12% interest, and they could figure out how to do it, which there's a way to do it. And how many members do you think you get from that? I mean, you could do it and tie it with a savings vault for lower income people and have it be a secured credit card, and who wouldn't get it? And you would have no defaults. It's just how you structure it. I mean, that's been a long time thing in the banking industry. I read an article like 6 or 7 years ago that I agreed with, and they said the banking people are missing a big opportunity, because banks always think this. When I was working, I had a ton of income. And so then I was managing my income going forward because I knew I used these payments. And so I basically didn't work for a year and didn't have any income. All right. So I went to refinance my mortgage, which I never missed a payment, with Citibank. And they said, well, you're not a good credit risk. I go, I'm not a good credit risk. What are you talking about? And they said, well, we'll give you a loan but your rate is, I don't know what it was, about 7%, but we'll give it to you at 9.5% or 10%. I go, if I'm not a good credit risk at 7, what kind of credit risk am I at 9? And that's typical for banks. They don't realize that of course you can't pay your student loans down when they're 11 or 12% interest rate, but if you put them at 3%, you probably get more of them paid off. And so you got to balance that between losses. And credit card companies and banks traditionally like the higher interest rates and the balances, because it throws in money into their accounts and they worry about the defaults later. That's why, so many people in credit cards, they just write them off. They're just like, I'm not paying my credit card, and then they're never going to go after me. And then some later, 2 years later, a year and a half later, they sold some collection agency, and maybe you collect it, maybe they don't. And they don't care because they're getting those 28% returns. But I think that's not consistent with getting your money right.
I've never looked into that. It could definitely be true, but I know that there are some credit cards that'll hold a 15, 18% APR, and then some of the other ones are 28, 29%. I'd be interested to see what the defaults are versus the different APRs, because even whenever I go to get a credit card, I never even look. I never plan on holding a balance.
Right.
It's just the benefits to the user that I care about. So
right, and you don't make the bank any money either. Right.
At the same time, I guarantee you the average person looks way more closely at whatever the credit card perks are than at the APRs.
Right. And that's that. Would you do that if you're in a business deal? Would you say, okay, well, I'm not going to look at what they're going to charge me? I mean, it's 28% rate is, because I know, because people in my family call me, they say, could you lend me some money? I got all this credit card debt, right? I go, how'd you get this credit card debt? You go, well, it's free money. I go, it's not free money. You got to pay it back, right? It's like, but I think there's a big place to get to use credit cards with lesser interest rates, because you'll get, like me, I might carry a balance for a month and you get 1% off me, but you're not going to make anything of me, because I like what other thing I like about SoFi's app is I charge something on the app and I see it immediately that I charge it, so it verifies if somebody else makes a charge, I see it right away, which they haven't. But then the next day it comes up and I just pay it off. I just pay it like 7, 10, 12 times a month. I just pay it off. I just have the money and I just like pay it off and I want to get the rewards. So there's a lot of things they can do with credit cards. They got to think a little bit outside the box. They need to turn that around.
I mean, they kind of have a system built in already where if you run up your credit card debt so high at 28%, you're probably getting a push notification from them saying, "Hey, you want a personal loan? we'll wipe that away pretty quickly."
I thought about that earlier. It's kind of a good setup to sell personal loans, but
yeah.
It's like, that works for so long with your customers until they figure that out. I mean, that's a good catch. Actually, I thought about that earlier. I said, that's kind of one thing somebody would say is like, it's funding their personal loans, but there's plenty of other 28s. I mean, the question is not to keep your members. You got to keep your members happy. You want to keep your members happy, but you also want to keep potential new members happy. You want to get new members. In my mind, it's all about the new members. The new members bring more deposits. Members bring more demand. Then you just got to determine what products fulfill that demand. That's the goal of every business, right? Get more customers, acquire them the cheapest you can, develop products that they like to buy, then develop other products that they'll buy and cross-sell them. It's like SoFi does a good job of cross-selling. Other banks do try to cross-sell. The problem is all their cross-selling opportunities are in people like, okay, you want to cross-sell wealth management, you want to cross-sell that with other loans, but they have loans in the wealth management department competing with their own loans, and they just don't talk to each other, and their systems don't talk to each other.
Yeah. I wanted to ask you your opinion really quickly on the doomsday versus sort of best case scenario for rates, just to understand your opinion here. So any sort of rise in interest rates, bad news for SoFi, clearly.
Yeah, it's not, they could get around some of it, but any kind of huge swing up is really detrimental for them.
Sure.
But it's also detrimental more so for a couple major banks and a lot of regional banks.
Right. So the likelihood is very low.
Yeah, should be very low.
But then also in your article, which people don't talk about, but I actually really liked what you said because I don't think about it often, a massive swing downwards in rates could also be very impactful as well on a negative direction.
Yeah, because number one is everybody is going to want to pay off their loans with new loans, and so that can cause problems. And you can offset that with the loans you have become more valuable. But then again, is you're offsetting it? You're not creating more EBITDA and more capital ratio, and you're going to have a lot more demand for other loans that you need that capital ratio for. So that's the balancing factor, right? That's the risk.
So
the risk always in a bank is management. It's always the management.
So a slow drip off of rates is the perfect scenario for SoFi.
In my mind, yeah. Okay. Stable, and then towards the end of the year, November, December, rates starting to fall. That gets them through what they need to do on a stable playing field. What's kind of going to happen. Kind of be consistent, and then the anticipation of those lower rates is going to help them sell their loans.
Right. And essentially, we've already seen that, right? Any time that the Fed gets even remotely talking about cutting rates, those quarters usually have a higher amount of loan sales. So
right, and they will, like, say they have in their model that they're going to have X amount of loans at X rate, and they're not getting enough income, but they're getting good. They're not getting enough loans, but they're getting good in principal. And the defaults are staying okay. They're just gonna ratchet it down a little bit. They're gonna, it's like they're gonna turn on the faucet, let more credit out. It's not like they're stuck one way or another in their model. That's what people don't understand. It's like when you're a management of a large company, every day you're managing, right? Every day something comes up. You have a manufacturer, and the manufacturer has a problem. You got to figure out all right, well, I got to get this. The manufacturer's problem is not my problem. I got to figure out how to fix it so it doesn't cost me much money. Every day is the management. And when you're growing and you're trying to have new products and you have all these different divisions at different locations, it's a tough thing to manage. So you can't really expect like, okay, well, where is the business accounts? Where is the new credit card? Where is the custodial accounts? Where's the retirement accounts? Where, that stuff, it all takes time and they'll get there, but people are in a hurry because they've lost money. It's a common thing, right? If everybody at $7 had bought at $4, you wouldn't have all this angst, right? It's people lost money and they have a fear of losing more money. And I completely understand it because when I grew up, I never had any money, right? I wasn't like the kid that's parents had a lot of money. And my dad and I lived together. I basically worked my entire life just to buy food. So when you don't have a lot of money and you lose it, you don't have a lot of opportunity left. And but there's always like, why do you think chain letters and MLMs and everything become real popular? Because it's a way to make money quickly when you don't have any money, and usually it's not.
So you grew up with no money. Now, how much money do you have? No, I'm just kidding.
So, Tim, maybe I can ask you.
I'll just tell you this. There's a lot of bears that say they have a lot of money, and I've looked at their situation, and they don't have 1/10 of what I have. Right?
I wish I had a.
But I will tell you. Let me tell you this. As long as we're telling people and people are listening, I think my regret in life was I worked too hard. And because I didn't have any money when I was younger, I always wanted to have enough security. And when do you think enough is enough, right? Because when is enough? And so then you got in this habit of like, for the first, in my legal career, for the first 8 years, I never took a vacation. And I go, I should have taken a bunch of vacations. I didn't buy a car until I was a lawyer for 3 years. I shared a car with my wife. And the funny thing is, the money I bought that car was trading in Telecommunication Inc., which is John Malone cable company in Denver. And I had $20,000. I saved up a car and I invested that in options. I did some really screwy moves. I made a mistake once on options. And I made $120,000 from it. And then I said, yeah, I don't really need. I'll go get a car, I guess.
Yeah.
But some of the biggest gains you have are by sticking with your thesis. So I'll tell the short story. I had all these options for Telecommunications Inc. They were going to become worthless the next week. They were worth the 16th, and the broker calls, you want to sell them, get rid of them, you get a 16th. I go, yeah, just sell them. Then I called them back, said, you know what? I had a couple of things before where I didn't stick with my convictions. I'd rather lose the money. It's taxable anyway. I made a bunch of money in stock options this year. Let's just let it ride. They go, okay. So they call me on Monday, said, oh, we executed that contract. I go, I told you I didn't want you to execute it. You go, well, it's better than a sharp stick in the eye. I go, no, just go back in the market and get them back for me. I just want them. I don't know what's going to happen a week. 2 days later, they sold it out, and those options were worth $110,000 rather than $1,500. And so sometimes you got to stick with your thesis, because my thought was, I lose another $1,000. What's it going to do for me? But you have to stick with your thesis until you're shown something that sticks with your that goes away from your thesis, right?
You just encourage so many fucking options degens to hold their YOLO calls to expiry, Tim. I hope you know that.
No, I like in Sofi, I wouldn't hold options because you don't want to talk, who knows whether the stock's manipulated or not, but it seems kind of crazy to me. And you start talking about what's the percentage likelihood that around earnings and places, all the stock always settles right on the number here, number there. I think it's not, leaps is fine. But if you have a leap for $1.50 or $2, I would rather buy the stock for $7.
People are saying, make him a regular on the show. I literally sent a text. So I joined in the call a little bit early, not to leak DMs here. And Tim doesn't even know that I did this, but we were in the call and I was just listening to him talk, and I just reached out to Tevis and Roy and I was like, this guy is a killer. This is going to be an amazing show. He's the real deal.
Well, I just have a lot of experience from not taking those vacations, which I don't. The only thing you have is your relationships with people, and the only thing you have is sharing memories. And I worked too long, too hard and got too much money for it, but I didn't get much of anything else for that period of time in my life. I mean, I retired from full-time job like over 20 years ago because my son's disabled, and I take care of him. Basically, he wasn't learning anything, and I decided I'm going to figure out a system where he learns, and I did that for 12 years. But I would always get consulting because I always have my ex-clients and ex-people go, we have this problem with our board of directors. We need to do this. And I said, no, I don't do it. He goes, well, what are you going to charge? I go, this was back a few years ago. I go, $1,000 an hour. They go, okay. I go, well, I'm only going to do it if it's a minimum 50 hours. They go, okay. And so I will do it for some people because I have certain, like from a valuation perspective and from a SEC fraud and accounting perspective, people want me to represent them. I don't represent people I don't know, but a lot of people I know end up getting in trouble. So I try to help them out. But if I can tell anybody a thing, take your vacations and screw your listeners on earnings week.
Well,
I did see a tweet that said that the earnings would have been better if Tanner actually had his show that week.
hey, I was on vacation. I'm listening to you early. I just got back.
Yeah.
So,
but I'm not telling people to buy or not buy. I'm saying be educated. Don't let people throw you off. I mean, you guys deal with this. I mean, Chris Hager does with it all the time. I don't know how he has all the time. And sometimes I do it because I think Chris is a good guy. I think Tanner, you guys are all good guys. Tavis, you guys work hard on this stuff. People don't realize how hard it is to do what you do. Like I was telling Tanner before, I said, I started watching Tanner because somebody else I was watching wasn't giving me numbers, and Tanner would give me the numbers. I wouldn't have to read all this stuff. And I said, I like to keep track of it, but something would come up, and then any issue would be on the show, or Tavis would come up with the show, or Chris would put in an article, and I'd say, okay, well, this is an easy way for me to keep up with the stock. And I just got, I keep up with it. I didn't say anything. In November, I go, these are people, every kind, I get in arguments with like several. I'm a Wall Street trader, and I go, did you ever run a business? Did you ever restructure a business? Did you ever restructure anything? You traded what, oil contracts, and now you know everything about banks. I mean, I don't like the bully aspect of it. And there's people who go, you're gonna lose all your money, you're not gonna lose all your money. You can't listen to those people because, book value, what's book value? 5 billion or 6 billion? You're gonna just gonna go to zero tomorrow. It doesn't make any sense, right?
yeah.
And it's not, and it's, on the other hand, it's like, I kind of like Kyle a lot, but some of the stuff when I see his stuff, it just like it makes me laugh. It's like he gives a lot of good information and timely, but like a year and a half ago it was like 10x this quarter, 20. I joke 20x next quarter. It's like it's just that people have to realize that and I use the Amazon as an example, but I could use Apple as an example too. It's not Amazon, it's not Apple, but the concept is still the same. It takes a longer time than you want to grow something big from nothing. And student lending business wasn't nothing, but it wasn't a major bank. And as you see, as they're going up the bank rankings, you just got to watch how it develops. And some of the people I think who invested in the SoFi, if they read everything and they say, if you need the money in the next 6 months and stuff, I'd say, maybe you reconsider investing. But if you don't, I think a lot of people are better off is just keep it in their account and not look at it for 2 years. You wouldn't have the angst. Just say, come back in 2 years and see what it is. I mean, like I said, is it really somebody thinks in 2 or 3 years it's not going to be $11 stock?
So I completely agree with you. And if SoFi hits their 2026 guidance, I think we completely look at this 100% differently. I think a lot of analysts and people are actually thinking that this won't be the case. It's not even just about price action. It's also that SoFi might not hit the growth that they're expecting by 2026. What are your expectations for growth over these next 2-3 years? You said you're a 5-year plus investor of this company and you'll play it as it goes, but what are your expectations long term?
Well, here's how I look at that, right? For SoFi, in my mind, when I first started here, was get your money right. We're gonna high net worth young individuals that are making a lot of money, and we want to give them like the same advantages as wealth management. SoFi will take off when they fulfill that promise, right? Because to get into wealth management, they have a minimum of like 10 million, 20 million, 50 million. A couple of guys I work with have one of the biggest independent wealth management companies. And it's like, they like turn people away with 20 million. They turn people away at 5 million, 5 million to 2 million. There is a great opportunity for SoFi to fulfill that promise. All right. And to do that, there's a lot of things they have to do, right? So they have to do some of the things you said. So for example, if you have a $50 million client, and for tax purposes, they don't sell their securities. They might issue some puts. They'll get some interest income, and they'll just borrow from the investment bank. And they ain't borrowing at 10%. They ain't borrowing at 28%. They're borrowing at like a couple percent, 3%, 4%.
Sure.
And the reason investment banks do that is because they're making a 1%, 0.5% management fee on their $100 million. And so you try to mimic that system. And how do you mimic that system? Well, you got to have like what they're trying to develop is various investment categories, like their it's like crypto, their ETFs and things like that. They have to have an automated investment for automated investment wealth management, which will then include retirement accounts. Will then include custodial amounts. Something that Steve mentioned in the show a lot. He's right. It's farther away. You can't just do that quickly. All right.
Right.
But if you develop that, once they develop, and you see that they're developing those core things to do that, then the guy that makes 150,000 this year, in 5 years he's making 300,000 or 200,000, and his wife's making 200,000, and now they have kids, and they need their checking account to be like Quicken. They need like a Quicken formula, so you can go in and you can set up everything, payments on them, and all the checks get issued or transferred electronically by them. They get a report like a wealth management person does. They get a report every month that says, here's where you spent your money, so they can check it. They get bill pay services, right? And then they get money management services. They get investment services. And it's kind of like they go one place. That is what I think Noto means by the one-stop shop for his target market. And once they get to that, it's an extreme growth, because you not only get the management fees, you get the custodial fees, you get the retirement fees, you get a better credit card. But the better credit card is actually, in my mind, the start of that. You need a better credit card, and you could charge, say, $250 for that credit card if it was like 8% interest, and you only give it to people who are never going to default, right? And so if you don't have any defaults, you're making an 8% return, plus you're making $250 a year, depending on what their credit limit is. That's like, I think I put in one of my tweets. I said, what do you do when you're like 20, to one of the bears? I go, what do you do when there's 20 million members and they come up with a credit card that they make $40 a year on, right?
Mm-hmm.
What do you got, like $1.660 a share just on that? Then what's the value of that company by itself? $30 by itself. Then you get a couple tech wins in the next 2 or 3 years, and then that grows. You got to give time. They have to build this and give time for their tech stuff to grow, right? Because that's the garden you have to water over and over. And I never expect, sometimes when they say, oh, we're looking at this, we're going to do this, and we'll let you know we're in the RFP process. I'm like going, RFP process? You know how far away you are when you're in the RFP process? Have you ever done an RFP? I mean, maybe tell us, maybe you've seen them. You get an RFP, we issued an RFP for Oracle and their competitors. And, the RFP process took us a year. I mean, 6 months, about 6 months. Then we got the responses. We go, well, we need this and this. What's the add-ons you have? Then you go this, and you go, okay, why don't you come in here and show us what it does? And then then you send some people to training to see how easy it is to use. And then you sit back and go, how much is it going to cost us? And then you negotiate, like we were going to negotiate. Well, we don't pay anything the first year because we're going to have all this testing and integration. We're going to run side-by-side systems. There's all this stuff you have to do. It isn't done in a year. It's not like, oh, tomorrow we're going to sign up Bank of America and start getting paid. That doesn't work that way.
Well, even for Galileo, right? Even after implementation, revenue can still be delayed. Right. They can slowly start to port over potentially new cards only or something like this. It's actually much longer. So,
but when you're selling software as a service, and it's like hooking them in, you give them a break on the first year, because when you give them a break in the first year, you're going to have a 5-year deal, and then you're going to have 2 5-year options maybe. Typically, those deals are 10 or 15 years. So if you break even in the first year, you lose money in the first year, you're going to have very high margin sales every year thereafter.
So,
but it's about execution.
So just even past the tech platform, maybe not the most exciting year to come. Maybe lending even decreases in revenue. And although, are you actually in that boat? Do you think that lending is going to decrease in revenue this year, or do you think that we'll come out still slightly above?
Well, whenever like you're going up in credit quality and trying to get more loans, it's going to be a learning phase. I don't know how much they learned in the first quarter. If they learned a lot in the first quarter, they might have a slower second quarter, but I think they'll learn through the second quarter. And as it depends on what happens with the Fed, depends on what happens with interest rates. But if it stays the same, it looks like they're going to cut now in 2 or 3 months. There's going to be an exceedingly higher demand for their loans at certain rates, because they want to buy those loans or pre-buy those loans before the rates go down, and the prices of those loans go up.
Yeah.
Right. And when they do that, they have to have a lot of capital ratio space to do that, because they want to issue way more loans and sell way more loans. But if they can't sell them, so then it's like, do we sell all our loans or do we sell some of our loans? Because then the value of the loans goes up the longer you hold it. They're in the reverse situation that they were when the rates went up. Right? They'll be able to sell everything. They'll be able to sell their book. They'll have increased fair values. They'll be able to knock off the fair values in their inventory by selling them and actually achieving them when they wouldn't otherwise achieve them. So
wait, hold on a sec, because I want to make sure that everyone's on the same page. So you're saying that these fixed income buyers, or the institutions that are trying to buy these loans, are going to try to buy it before interest rates start getting announced, to try to get a better price before they know that the price of these loans are going to start increasing.
Right. I'll give you an example that I'm more familiar with. Right. Insurance company buys loans all the time, 4%, 5% loans, because it's in their model. They can survive on 5 or 6% returns. And so if you're an insurance company and you're looking, you first have to be assured that rates aren't going to go up. But insurance companies usually buy these loans, they just buy them like every month without looking. But when rates start to fall, they tend, in my experience, for the loans that I was talking about a number of years ago in Bob, they will buy more as they see rates are going up, because they'll pre-buy for the next quarter or the next interest. So there'll be a little bit more value, but it won't be as much value as if you held the loans to the next month or next 2 months, and if rates do go down. So it's guessing rates is a very tough game, and it depends on the macro. But my general viewpoint is, if that macro plays out like that in the late third quarter, they're going to have capital ratio room to issue a lot of loans, because they might want to sell some of them. They might want to hold some of them, because they can sell them later and get a higher net interest margin than the new loans.
So where does this get to then? Because we already sold, I think it was 1.9 billion of loans this quarter. Was that institutions trying to get ahead of the curve here? And if that's 17.3% capital ratios, like how many loans are they selling?
It's like, would you sell your house? Okay, I'd like to use simple examples. Would you sell your house? At some price, you're going to sell it. I mean, I have a very big house. I tell people I'm never going to sell it. My kids live here. It's a great house. I got a basketball court and pool, whatever, and I'm never going to sell it. Now, if somebody offers me 3x, I'm going, well, I guess maybe I should sell it. So it's a question of what people want and when they want it, and what the insurance companies believe the rates are going to be, what the Fed thinks the rate's going to be, and what Sofi. So it's a combination of everything. So you really can't tell for sure what's going to happen. You can only guess, right? But you have an educated guess. And so an educated guess would say, yeah, I don't think it's the first quarter, because in the first quarter there was still possibilities of rate hikes. So, but people buy this stuff every quarter, right? They need to, insurance companies insure people. They need to buy it every quarter. Other buyers of this need to buy it because they need to have the investment. And it's relatively the default risk is relatively low, even though some people will say the defaults are going up. Of course, defaults were artificially low for a couple of years because people were getting $3 or $4 or $5 or $6,000 just given to them by the government. There was too much money floating around. I mean, during COVID, I went to Vegas and I know I'm not the poorest person in here, but these people all have like $5,000 and they're gambling at the table, and I'm not that big a gambler, but I'm like, I felt kind of poor because all these people just taking this money and spending it, and people had a lot of money built up, so they didn't default, and that runs out. That's almost gone, and so you can naturally expect that default rates are going to go up. Now, if default rates happen, if default rates go up dramatically, that's a problem for everybody, right? Mm-hmm. That means you're heading into a recession, and all bets are off if you head into a recession because insurance companies don't need to buy loans if they're not selling insurance, right? If people don't have enough, they're out of a job, they're not going to they can't qualify for a loan, and so your demand shrinks. Your supply would still shrink a little bit too, but there's not as that's the bad case scenario, right? Recession is a bad case, rampant inflation. Everything on the outside, everything is bad when it's rampant. Rampant growth, rampant fall off in interest rates. If you have just a general business and like you're selling a product and your guy comes, this because it happened to us, he goes, well, we can sell like 100 million more this quarter. I go, well, we can't make 100 million more this quarter to sell. Because, well, the guy's going to be pretty pissed off. We say, no, I said, before you go out and make these sales, big sales, it's great that you did this, but can we go shift them into like 20 million this quarter, 20 million the next quarter? Because you need to ramp up for that. It takes a lot of capacity. And you don't know if you have inputs to your capacity. I mean, a bank is a little bit easier because you just need more money, but it makes it easy, and that's what the risk is. You have all this opportunity that comes to a bank. You need the cap ratio space to take advantage of the opportunities. So when you take those opportunities, when interest rates are falling, you're taking those opportunities, but also is an environment where you can really sell those fast so you get your capital ratio back. And so that's why in one of those articles I said, well, declining in your bare thesis goes out the window in a declining rate environment because you can sell more at higher and defaults are less.
Yeah, no, I guess I'm just sort of thinking about now because you were talking about something about the price of the loans or the defaults the longer that they are going on, or something along. I'm messing it up now because it was a while ago. But was that in reference to Chris Lapointe talking about how they're now seeing higher defaults at the start of the loans versus at the end of the loans? Do you know the sentence that I'm talking about? Because I wanted to talk to you about this and the shorter life of the loans that they're now signing on and what you think about that.
Yeah, I don't think I actually talked about that, but we can talk about that.
Okay, sorry.
There are some people who get personal loans because they're in over their head. And when you're in over your head, you try to get money to stop the bleeding. And sometimes because the reason you got in that place to where you are bleeding is that you don't know how to stop your spending, and they will get a personal loan and they will immediately default on it or soon default. They'll make a couple payments and default because they got in over their heads.
Sure.
It's a little bit intriguing to me because I don't know. I know he said that, but when you're talking about people that make an average of $150,000 a year, I mean, I'm not, it's kind of hard to see where they get in the boat where they're defaulting and they get a personal loan for example, to reduce their credit card balance, and then suddenly they're always now they can't pay their personal loan. It's that happens because I think when you loan people money to pay off their credit cards, there are a portion of those people that now will use their credit cards more, and now they have more debt that they can't satisfy. And so the question is, they should have enough data on those people to minimize that, but that's always a risk when people actually lose their job. Yeah. The first thing I do if I was in a job and I lost my job is I go get a personal loan to carry me over, and then I realize I didn't get a job in 2 months and I can't pay the personal loan. I mean, that's kind of what I would say would be the problem, or would be the mechanism of which that happens. But you have to find a way to review that situation in the underwriting process. you're going to have some of it. You're going to have some of it in an environment where the Fed was trying to push up unemployment rates too. Because I'm sure there's a lot of people. I know somebody, a friend of mine was worked for a company and he got laid off, and he sent out 600 resumes, had a very good quality job, had good reviews. He just got laid off, and out of 600, he got 4 callbacks, 2 interviews, and a job. But I think retail, for example, and people think like, okay, well, retail is slow, it doesn't affect anybody. Retail affects like everybody, because retail goes down, suppliers go down, cotton materials go down. It's when things start going down, it's hard to stop. Just like when things start going up, it's hard to stop. And the Fed, the transitory, they stayed too long on transitory, but now to me, they're kind of making the right decisions. I just don't know how to work out, because I have a little bit of concern about how the election throws a monkey wrench into everything. Are they getting the numbers? What numbers is the Fed getting? Are they getting real numbers? Are they getting? I need the number because I need my I need to get reelected, so the White House fudges the numbers. They did that back 20 years ago when people were running for office. I forget what it is. I looked at it, I go, the number was then it was one number, and then 3 months later it was completely crazy different number, and they said they fudged the numbers, which they probably did. But the election is my only monkey wrench in the whole thing, because I don't want to get into politics about it, but it's not like people are totally honest with stuff when they want to see a particular person on either side get elected. It's not. It gives me a little bit of hesitation of how, I think Powell's strong enough to do what he needs to do. The question is he relying more on third-party information like that's provided by universities and stuff, or what's their agenda? That's the hardest thing to fit in an investment scenario. So I just ignore it.
So I've got one last question. Then if Roy or Tevis want to wrap it up, because I just realized the time, we are a little bit past. So there was an audience question here. How likely does Tim think that SoFi may get bought out? And if you want to also add, but I don't know if it's important, who are the likely buyers?
I don't think it's that likely. I'll tell you why. In just my own personal experience dealing with executives in very large companies, I used to think when I was in college, a lot of these large companies, wow, look how well run they are to be so big. And then after practicing consulting for a long period of time, I go, wow, look how big these companies are that are run by idiots. The problem with the big banks buying out SoFi is, of all the people I know that are doing that, their egos won't let them do it. And the guys that are really smart, like the Jamie Dimons of the world, who's the only person I mentioned because he's really smart. I mean, first of all, do you think Jamie Dimon wants a big competitor? Well, he doesn't. But is he a buyout candidate? He probably thinks he can do it himself. He probably thinks they're too small. They're really small compared to like a lot of the big banks, and so that's actually good, right? Because you're not, you're not a target. But they're very, I've talked to guys at banks. They're very well aware. People don't realize this. Go and look online. How many branches Wells Fargo is closing? How many Wells Fargo is laying off a ton of people? Bank of America is laying off people. Bank of America is closing tons of branches. It's being a disruptor is working. The problem for SoFi when you're a disruptor in the banking industry is you're disrupting the industry where your stock price gets affected because you're part of that industry. You're disrupting your own industry, so it hurts you too, even though you don't have any commercial loans, or you don't have the same problem that SVB does. It hurts you because the whole sector goes down. You've got to all these algorithm tradings and things that trade on news, and so there's a big incentive to throw out news that's negative. If you're shorting, there's a big incentive to throw out other news because the algorithms run with it. And SoFi's trading patterns around earnings are such that you buy before and sell after. You buy before and sell after. It's a buy before and sell after. It's worked for like 6 quarters, and so that trading pattern is actually hurting the price of the stock.
So you really don't think that they're going to get bought out? I think it's
No.
funny that you
I
even
wouldn't want
brought
them to get bought out. I wouldn't want them to get bought out because if they don't get, like, my scenario is like in 10 years, maybe that stock's significantly over 100 if they do it right. If they do it wrong, it could be 30. But I'd rather have it be 100 than 30. It's like somebody says, I want to be bought out for $12. I go, okay, well, I make a bunch of money if it's $12, but I'm not making what I think I can make otherwise. The biggest thing you are when you start a company is you don't want to give away, in venture capital, you don't want to give away the whole company because you're not going to then share in the upside of your ideas, right? As a disruptor. I mean, just imagine if Amazon had to sold out to somebody. They sold out to Walmart. You wouldn't have the same. You wouldn't have anything. You wouldn't have the AWS. You wouldn't have the competition with Target and Walmart and Amazon. You wouldn't have a lot of things that competition occurs. And I think Jamie Dimon's probably the only one that probably realizes that SoFi's competition might be good for his bank too.
Yeah.
Because if SoFi takes away a lot of Wells Fargo customers before they take away Jamie Dimon's customers, is that not good for Jamie Dimon?
Yeah.
Right.
Okay, so I want to make sure because we're already 20 minutes over, but it was absolutely great conversation. So thank you, Tim, for being on.
No problem.
Usually we go a little bit over time off this live stream on the SoFi Weekly after hours. We'd love to have you. Usually we talk about other stocks, what you're investing in, what you've seen in the news lately, these sort of things.
Yeah.
So if you'd like to come on and talk about the rest of your portfolio,
Well-
Robinhood or
Well,
some of these other
here's something you need to know. The three patterns there, my portfolios for my kids are like index funds. I got some Robinhood for him, my kids. I got a little bit of PayPal. I think Palantir is a good stock. I haven't bought it yet. Long term.
Yes.
But personally, I own a ton of real estate. SoFi is my stock because I own two businesses. See, my idea is I'd rather own business. I'm not Warren Buffett. I'm not like the W and Warren even, but I like to buy businesses and take a bigger position in businesses. I don't like to hold a lot of stocks because then I'll have a tendency, like you guys, is to watch them and it'll take up all my time. I'll be watching not only Tanner, Tevis, and Roy and Chris. I'll be watching like the multiplication of 15 of that, and I just don't have the time. And I think, are there other stocks that'll grow faster than SoFi? Yeah, but I've known a lot of guys like in Security Pacific Bank, which was a startup bank in California that got bought out Bank of America. I know a lot of guys that just bought Security Pacific Bank and a couple other banks, City National Bank. They bought a little bit, and 20 years later, they were multiple millions just on those investments. And so that's kind of why I do it. I think, they're a disruptor. I really don't like paying bank fees, and I don't think that gets emphasized enough. Every time I just open I have my business accounts, and I have to have a personal account on Bank of America with my business account. They just charge me a $16 fee, and I don't know what it's for, and it just like steams me. I go, as soon as I get my business account out of there, I'll do it. But I don't think that's this year for SoFi. I'd be very surprised if it was.
It's funny how terrible people feel about your product whenever you continue to rip them off.
Oh yeah, it's just, but that's why I think some of the SoFi investors, they feel kind of ripped off. I thought we were going to get this year. I thought we were going to get this year. I thought we were going to get this. And they think about it. I don't know if they think because they want to use it. I mean, like the dark mode, I've never really got dark mode. I don't like dark mode. It's just like, I'm like, shut up with the dark mode. It's like, who cares? It's light mode, dark mode. It's the same thing. You click a button. But it's like, like Zelle's a very important thing. Credit card's an important thing. I wish they would turn the credit card offering around because it not only becomes very positive, it's positive, and you get rid of the negative. And so that's usually in business, if you can turn your negatives into positives, that's your first target.
Yeah, that for sure is coming soon, a lot sooner than we thought. Just the way that they talked in the earnings call, credit cards were scarcely mentioned for at least 3 earnings, if not 4. And then a whole lot about credit cards. So
yeah,
they're working on it. I don't know when, but I expect to see something this year. So,
but you do have to be careful with credit cards in an environment if interest rates are going up. or if you're getting a recession. So you have a sweet spot within those two. So it's not an easy thing for them to sort out. I mean, this Robinhood, for example, their credit card is like, okay, well, yeah, they got billions of dollars in. They paid like 125 million. They're going to allocate it over 30 years or whatever they're going to do. Or I don't know what they're doing, but I go, I told somebody the other day, they asked me about that particular, and I said, well, if you date your girlfriend and you don't have a bunch of money and you take her out to expensive places, and you marry her and you borrow money to take out to expensive places, what's going to happen when you stop taking her to expensive places? Right? She might not stay with you at that point in time because you've conditioned her to want stuff. And so when you condition your customers to always get things rather than have stickiness, right? So if you condition your customers like, I'm going to wait to put more deposits in until I get another 1% or 2% bonus. Or do you want to give them services that they really can't live without, that every month they need, right? So for my retirement account, do I really, I'll go to Robinhood and take my retirement account, I'll let it sit there, my account, and I'll get the 3% bonus. I don't know, how that affects them because I'm not going to do anything in it. I mean, it's very good. And I own Robinhood for my kid because I think it's a good company. I just, buying customers leads to buying customers. And I think their gold credit card is a good offering if you want a credit card, but I don't know about for myself.
Sure. Well, okay, let's transition over to the SoFi Weekly After Hours. Thank you all so much for watching. If you guys want to check out Tim on X, let me bring it up again. I think it's Tim_Sweeney_TAR on X. Please check him out. He posts unbelievable articles there. Forget 240 characters. He's breaking all the rules.
Yeah, don't expect that too much.
You need to catch him on a good 2 a.m.
Yeah.
He's had a cocktail or two and he's just getting pissed looking at bears talking about SoFi. So he'll start writing then.
Yeah.
All right. Thank you all so much for watching, and bye for now.
Bye.